Tata Motors seems to be unstoppable today, and that's after a big upgrade coming in on the stock after the foreign brokerage firm Morgan Stanley upgraded the rating on the stock, and as well as that, they have also raised the target price on the same. From the equal weight rating earlier, they have now upgraded and given it an overweight rating, and along with that, they have raised the target price from 298 rupees per share to 448 rupees per share. They see the kind of upside that they are targeting, and that's surely visible on the stock price rise that we are witnessing. The stock is more than up 9% the time I'm recording this link, and Morgan Stanley is even more seeing more upside coming in the times ahead, and that's backed by a very positive commentary, and let me highlight the same for you. In the report, they say that Tata Motors as a company that was more seen to be as a JLR play, as a global luxury brand, but now they believe that the incremental upside surprise will come from the Indian business, which will be a beneficiary of high operating and financial leverage, and along with that, the market share wins that are being seen in the India's passenger vehicle and commercial vehicle business could be a re-rating factor for the company and would help it to transform its image from a global luxury play to an India play now. They expect 2022 and 23 to be very strong for India auto sector, and Tata Motors India business will also be a beneficiary in this one. Apart from that, they also highlight key pillars for the overweight thesis. First up is the commercial vehicle business is set for cyclical ride. That's they are highlighting, and along with that, talking on their passenger vehicle business, they say that the current market share is at 10%, but this will experience value rising as it moves to free cash flow neutral, which they expect it to be achieved by FY24. Along with that, they also highlight in the India passenger vehicle segment that this could witness a very much margin upside, and margin improvement can be seen, because if you see in financial year 23, from financial year 23, the business will be moved to a separate low-debt subsidiary, which will experience aggressive cost cutting, and leverage gains will be visible, and this will derive the passenger vehicle business EBITDA margins to 8.5% by FY24 versus just 2% that was recorded in FY21. So from 2% to 8.5% of EBITDA margins is what they are expecting in Tata Motors India passenger vehicle business. And now talking about their JLR business, they do highlight that post the semiconductor shortage, this will also see an improvement, and they see meaningful free cash flows in FY23, and on and whole, they find the risk reward very favorable for Tata Motors. As an impact of this report, not only Tata Motors is surging and riding ahead, you see an impact on all the auto companies that are riding very fast in today's trading session, and that's the impact after the Morgan Stanley upgrade on Tata Motors.